All right, we will officially kick it off now. So, as I said, for those of you that have joined since we kicked off about a minute ago, my name is Nick Olson, Director of Private Wealth here at Kathmere Capital. Today, we're going to be, we have Nick Ryder, our Chief Investment Officer, who's going to be talking through the 2020 election, how to look at your portfolio, what history has told us. This is probably the most common question we've gotten over the last few months, and especially the last 30 days here as we're coming in to the last couple of weeks. So, Nick, thank you for coming out and hosting us for this and taking care of all the slides and putting it together. I'll pass it over to you now.
All right. Good morning, everybody. And I'll echo Nick's sentiment and thank you all for taking the time to dial in today. And hopefully you'll all find this informative. Really, our goal with the webcast today is to really step away from some of the partisan rancor and speculation we've heard from kind of both parties and folks of various political persuasions, and add some fact-based reality and empirical evidence to the picture here, as we think about the upcoming election and what it may mean for the economy and markets more broadly. So I will start just here on the first slide with perhaps a bit of levity. One of the things that we often hear about right now is folks decrying the amount of vitriol that's taken over politics and how bad this election is from that perspective. And just going back through history, hopefully we can see that vitriol seems to have been a part of our political process really since our founding days as a country. So just a couple of interesting tidbits I was able to dig up through time here. So just looking on the left, the whole notion of quote unquote fake news, really nothing new. We've seen none other than George Washington, our founding father, as well as Thomas Jefferson, add to the comments in terms of or expressing their dismay with the coverage they were receiving in the newspapers during their presidencies. So you can see some quotes from each of them there on the left-hand side. Personal attacks. I would say the types of attacks may be a little bit different today, and they may not be quite as eloquently stated as they were in the past. But we see here just in the middle, we have in the 1800 election, President John Adams was at the time then running against his, at the time, Vice President Thomas Jefferson. During that period, Jefferson, you can see, referred to Adams as a hideous hermaphroditical character, which has neither the force and firmness of a man nor the gentleness and sensibility of a woman. Adams' team, it's some of the historical record is conflicted on whether or not Adams himself said this or it was just his team, but he referred to Jefferson as a mean-spirited, low-lived fellow, the son of a half-breed Indian squaw sired by a Virginia mulatto father. So maybe not quite Sleepy Joe and Shut Up Man, but nevertheless, personal attacks at the time, something we've seen through our history. And then just on the far right hand side, we haven't yet seen a duel during this election season, but even that wouldn't be unprecedented, as we saw back in the early 1800s, sitting Vice President Aaron Burr famously getting in a duel with founding father and former Treasury Secretary Alexander Hamilton. So just hopefully a bit of levity. We have certainly seen vitriol and rancor in the past between candidates involved in politics. One thing we do know, and this is a slide we've shared on occasions in the past, is that party affiliation certainly does appear to have an impact on how all of us assess economic conditions. So what we show on the slide here is the Pew Research Center has been running the survey for a number of years, asking people to assess or share their assessment of current economic conditions. And folks are asked to rate current conditions as either excellent, good, only, fair, or poor. And Pew then further breaks them down into their partisan leanings, whether it's Republican or Democrat. And what we show on the chart here is just the percentage of both Republicans, Democrats, as well as the overall population who rates economic conditions either as excellent or good. So there's kind of top two ratings available. And what we see through time is a pretty clear relationship between whichever party is holding the White House at the time or the presidency. folks of that political party tend to consistently rate the conditions higher than those of the opposite party. So you see through the early 2000s there, when George W. Bush was in office, Republicans consistently rated the economy more favorably than Democrats did. During the Obama presidency there from 2009 through the end of 2016, you saw, while at an overall absolutely lower level, nevertheless, the trend was that Democrats consistently rated things more favorably. And then sure enough, over the last 4 years, flipping right at the election, really, or right at the time Donald Trump took office, once again, Republicans rated things consistently more favorably than did Democrats. So this is just a reality of the environment we operate in, whereby we should all recognize that our assessment of the economy is certainly influenced to some extent, probably more so for some than others, but nevertheless, all of us, it seems that the way we assess the economy and probably by extension markets is going to be at least influenced by how we lean politically. So I think it's just something that we all would be well served to recognize that bias that's probably inherent in all of us. What we've seen, though, from a purely empirical perspective in terms of market performance, is that markets have performed well during both Republican as well as Democratic and presidential administrations. And so I look at the data, and here we're going to go back since the end of World War II, covering all the presidential terms. We plot the annualized performance of the S&P 500 during there, colored red and blue for Democrat or Republican. And I look at this data and say neither party can conclusively lay claim to superior financial market performance. I think the average comes out maybe slightly ahead of Democrats, but what you have seen certainly is that there have been periods of both good and good performance under both types of administrations. Certainly a few outliers there, starting with Nixon there in the early 70s. Nixon's a bit of an outlier, certainly in the sense that the presidency was cut short, but also ultimately a handful of things occurred during his term that were probably beyond his control, namely the oil crisis of 1973. But there was probably certainly some policy blunders that occurred there, but ultimately it was a term cut short, so maybe not even a full sample. The other point I would take from this, and we'll get to on the next slide, is that starting points really do matter a lot for market performance during presidential terms. You'll see George W. Bush, obviously a big negative outlier in terms of market performance during his presidency. On the flip side, you have the Obama administration delivering very strong returns. What I would argue is that starting points really do matter a lot. So at the top of the chart here, we show Ronald Reagan and Barack Obama, two past presidents that I think most of us would agree not a ton of similarity in terms of their philosophical beliefs in terms of policy and preferred policy outcomes. Certainly very different enactments of policy during their terms, but what they both certainly shared in common was very strong S&P 500 market performance during their term. You see Ronald Reagan there at 14.6% per year. Barack Obama, it was 15.5% per year while he was in office. What the two did have in common, though, is the starting points. They both entered office during really a cyclical trough in the economy. During recessions, we can see that in both cases during the prior quarter, GDP growth was negative right before they entered office. So the fourth quarter of the preceding year, you saw Reagan entered during the 1980 recession. Barack Obama entered during the depths of the global financial crisis. With that, you saw high unemployment rates and importantly, depressed valuations in the equity markets. So Ronald Reagan, from a cyclically adjusted PE ratio, as many of our regular listeners know, is kind of my favorite broad market valuation metric, down in the high single digits, a level we have not seen since Reagan taking office. Barack Obama there at 15.4. Just to put those numbers into context, over the last 50 years, that valuation metric has averaged in the low 20s. So you can see both of them at very low levels relative to kind of longer term averages. Both then, coincidentally, coming in during a recession with low valuation, set the stage for recovery and ultimately strong market returns. On the flip side of that, from a starting points matter perspective, George W. Bush coming into office nearly at the highest all-time price to earnings ratio we had seen, 37.3 times 10-year earnings. Had come into office after a nearly decade-long expansion. The economy had been expanding ever since the 1991-92 recession, shortly after Clinton had taken office. And so what you saw was a long expansion that was already showing signs of age and weakening in the economy when Bush took office, with sky-high valuations there with the dot-com bubble. And Bush entered office in um, January of 2001. We had seen the market peak about a year before. It had already started downward trending. Of course, then he was followed by 9/11 shortly after coming into office. So a number of factors working in Bush's favor. And then, of course, the term bookended with the global financial crisis. So, the takeaway for me here is we should really look to not ascribe perhaps as much either celebration or blame to presidents based on what happened in markets during their term. We should really also put a lot of emphasis and just understand the environment in which they took office. This slide here shows, one of the things we'll typically see in the financial press these days, or on whether it's the news on TV or in newspapers or any other type of financial press, is folks trying to look for clues to say which type of partisan outcomes have been historically most favorable to investors, and conversely, which ones have been poor. So, right, a lot of the debate these days, or a lot of the conversation, is around, if we were to have a Democratic president, many have said, okay, a divided Congress or a Republican Congress, kind of an environment of gridlock, has tended to do the best during such environments. And that, on the flip side, if you were to have a clean sweep, this may not be a good thing. And certainly then on the Republican side, there could be different outcomes that people look at. And what I want to highlight here, and what we see at the top of the page, is just showing median annual returns under different partisan outcomes, combinations of the presidency and the composition of Congress. And you can see the performance kind of does range from a low there with Republican president plus Democratic Congress of 4.9% median returns, and on the flip side, Democratic president with divided Congress of 13.6%. These data is all going back since the end of World War II. But what I suggest is that we all should take these types of figures with a grain of salt. From a statistical perspective, they're not overly reliable, and that's simply because we just don't have that many years of experience with which to evaluate these. We have, in the statistical terms, a very limited sample size. For instance, that Democratic president plus divided Congress, we've only had that outcome 4 different years over the last 80-year period, even the highest of which you've had 22 years of data. From a statistics perspective, that's just not overly reliable for us. And so what we see here at the bottom of the page is from Goldman Sachs, just doing an analysis that simply said, from a purely statistical perspective, how much does the makeup of the Oval Office plus Congress explain in terms of annual market returns? And what you'd see is, if a variable or an independent variable fully explained an outcome, you would see an R squared, as it's called, number here of 1. If it explains nothing, you would see it at 0, or a very weak relationship, it would be down at 0. And that's exactly what we see in the data, which is, from a statistical, purely empirical basis, who controls the White House plus Congress has 0 explanatory value in terms of what to expect in market returns. And that makes sense, I think, to a lot of us, when we really step back and think about it, which is that there are so many other factors that go into driving market returns other than just the composition of political power. And so, the takeaway for me on this slide is that we really should be humble or a little skeptical about these claims about, hey, this outcome for the election would be really good, or conversely, this outcome wouldn't be very good, and realize that there's a lot of factors that are going to be driving market returns, and the political side of it's just not the biggest one. I would say this slide here too comes from an analysis from Goldman Sachs. That there is maybe two prevailing trends that do seem to hold water from a statistical perspective, and these can be broken down into pre-election and post-election. What the chart we show here at the bottom is just plotting the average of the S&P 500 return during election years, and it's divided into kind of two different states. One where the incumbent party wins, which is the reddish orange line, and the other is when the incumbent party loses. And so it's just presenting the average of those periods. And kind of the two key trends that do emerge in the data, which seem to be quite reliable, or at least more so than what we saw on the previous slide, was from a pre-election basis. Basically, strong market performance into an election, or weak market performance into election, does a pretty good job at predicting who will win the election. So historically, if markets have been positive in the 3 months heading into the election, the incumbent party tends to win. And when markets have been negative in the 3 months heading into the election, the incumbent party has tended to lose. So just simply following that very simple up or down rule has predicted 20 of the 23 presidential elections since 1928. So pretty reliable indicator there. As we sit here today, we've seen the market up over the last 3 months by about 12%. That would suggest that Donald Trump's odds to win are boosted by such a simple metric. Of course, this election season is anything but normal in a number of respects, and there certainly have been 3 instances where this rule hasn't held in the past. So we shall see, but that's kind of been one trend that's prevailed. And I'd say more importantly, for us as investors, or something that we can all take solace from, is that on a post-election basis, regardless of whether or not the incumbent party has won or lost, you have seen a bit of a post-election rally from election day heading into the end of the year of about 3%. You can see that there on the right-hand side of the slide. And there's probably a number of reasons why that happens. I'd say if we were trying to assign a narrative to it, it's most likely the fact that you've just had a cloud of uncertainty lifted from markets, and we do know that markets generally disfavor uncertainty and prefer more clarity on policy outcomes. And so you start to get that just by having the election in the rearview mirror. This slide here comes from Invesco. It's one that I think it assuages a number of folks' fears, which around there's constantly this concern, which is that a new administration or new makeup of Congress has the potential to radically re-engineer the economy, and that such a re-engineering could be very disruptive. What we show here on the top is just simply breaking down the U.S. economy's GDP into its 3 primary sources going back since 1957. And so we break it into personal consumption in the teal shading, business investment in the lighter blue, and then in the darker blue, government expenditures. We don't show net exports or imports just because they are actually accounted for within these various segments. But what we see over time is that the composition or breakdown of GDP has remained relatively constant. You've seen personal consumption typically right in there at about 60%. We've seen business investment then about 20%, and you've seen government expenditure about 20%. Of course, those numbers do have some noise and fluctuate, to a couple percentage points either direction through time. And what we can see called out is that's held constant despite some pretty significant changes in policy enactments over the year, ranging from Lyndon Johnson's Great Society, the tax cuts during the Reagan era, the welfare and entitlement reform signed into policy by Clinton. We also saw the Affordable Care Act, also known as Obamacare, in 2010. And so those are just 4 of them. Obviously, there's a whole host that not shown there. But nevertheless, the economy's kind of been, the composition of GDP has remained relatively constant during that period nonetheless. And from a market perspective, if we were to really zoom out at the 30,000 foot level, we can see that the S&P has continued kind of its upward march to the right. Investors have been rewarded for their ownership stakes in U.S. companies over the long haul. Certainly, there have been blips in noise along the way. I'd say some of them aren't even, or the majority of them aren't even related to policy, but nevertheless, you've seen capitalism continue to progress nonetheless, and investors, broadly speaking, have been rewarded for those ownership interests in great global companies. The next two slides here, I just, one of the things we often hear about heading into elections is predictions. Oftentimes there's conventional wisdom in terms of predictions on what a specific presidential administration will mean for the economy and by extension markets. My broad takeaway is that generally a lot of the conventional wisdom on these things is misguided, at least as it relates to what will be the market impact. I think oftentimes the policy impact gets fairly accurately predicted, but how markets react is oftentimes something quite different than what many assume. And I'll show this just looking at first here, President Obama's term. If we rewind the clock back to 2008, early 2009, when Obama took office, much of the prevailing conventional wisdom as it related to broad economic and market events was a prediction for massive federal deficits. Right, we started with Obama signing into law the American Recovery and Reinvestment Act in 2009, the at the time $830 billion stimulus program. As an aside, I look at that as such a quaint number relative to what we've seen, obviously, thus far in 2020, with the CARES Act, of course, being $2.2 trillion price tag, and another, ongoing debate for, anywhere between $1 trillion to $3 trillion of additional policy stimulus. But nevertheless, the prediction at the time was, okay, stimulus plus other policy enactments will lead to significant federal deficits. And actually, those predictions came to bear. The federal government did run deficits in excess of $1 trillion in the fiscal years 2009, 10, 11, and 12. But all those predictions were really kind of unanimous in calling for a handful of things to occur. We called for rising inflation. Meaning at the time, we're predicting inflation, a return of inflation like we saw in the late 70s into early 80s. We see on the left-hand side that simply did not come to pass. We just show rolling one-year core CPI inflation. We see inflation struggled to ever move above 2% on any persistent basis. And I'd use 2% as the number there, as that's what the Federal Reserve's targeted monetary policy inflation level is. But we see inflation kind of remain pretty low and stable. Certainly nothing at all to the double-digit inflation rates that we saw in the late 1970s. With the expectations for rising inflation caused by the deficit, there was predictions that the U.S. dollar would crater and lose its standing as the global reserve currency. I guess you could say that maybe came true for a short while there during Obama's term. You saw from a trade-weighted U.S. dollar index, it ended 2008 at 100 and declined 15% from there. But ultimately, the dollar ended Obama's term at a higher level relative to our trade-weighted peers than it began. So that one didn't necessarily come true either. And the other side of it was, alongside of these deficits and rising inflation was calls for significantly higher interest rates or a return to the 14 to 16% treasury rates we saw during the late 70s and early 80s. And we show there at the bottom of the chart that just didn't come true, with treasury rates incrementally inching up initially during Obama's term, but ultimately ending his term right basically where they started. So all three of those, I would say, incorrect predictions, despite the fact that the underlying premise of deficits did come true. And then on the right-hand side, the other side was, you had a lot of fears that expansion of government involvement, rising taxes would just lead to a poor market environment in general. We've already discussed the fact that simply didn't come true, with S&P 500 delivering a 15.5% annualized return during the 8-year term. And the other side, from a policy perspective, there was a lot of hand wringing and a lot of concern at the time around, what would be the impact of healthcare reform from the enactment of the Affordable Care Act that ultimately came to bear. The concern at the time was that more government involvement in healthcare would lead to a very bad environment for healthcare stocks. That did not come to pass either. We saw healthcare stocks there up just about 16% a year during the term, actually outperforming the S&P 500. And the other sector that we were all told to avoid heading into Obama's presidency was financials, given the potential for, and what was ultimately enacted, some pretty significant regulatory regime changes on financial stocks. And nevertheless, during Obama's term, we did see financial stocks outperform as well. So we looked during Obama's term. Oftentimes, I'd say the takeaway was that the conventional wisdom just did not come to bear in terms of accurately predicting market impacts. We can look back just 4 years ago and kind of run a similar exercise. I think many of us can remember in 2016 heading up to the presidential contest between Trump and Clinton. The general consensus at the time, we may all kind of forget this, was that Trump victory would just be New York Times essentially guaranteeing that we would see a significant global depression if Trump was elected. Other market forecasts called for a swift and significant correction in markets, and a very tough time for markets if Trump were to be elected. We know thus far in the nearly 4-year experience that just hasn't been the case, for the S&P 500 delivering north of 13% per year through the end of September. And the other side of it was from a more thematic or sector oriented, was many predicted that Trump's quote unquote, once he was elected or came into office, his quote unquote America First policy platform of cutting taxes, enacting new trade barriers, kind of a move towards deglobalization would benefit small cap stocks. That hasn't come to bear there, as we see that small caps have underperformed the market by about 9% a year during the last nearly 4 years at this juncture. The other couple sectors that there was kind of unanimous consensus on was that Trump would be good for energy, given a less heavy-handed approach to environmental regulations, as well as just more support for fossil fuels in general. You can see, as we know, that certainly has not come to bear there, with just energy being far and away the worst performing sector of the last 4 years. And then on the other side, to a lesser extent, there was a lot of optimism that Trump's policies would be good for financials as well as industrials. Financials, it was kind of a reversal of the heavy-handed regulatory approach from the Obama administration. Financials have underperformed by about 6% a year. And then industrials, is widely assumed, would benefit from a massive expansion of infrastructure spending, plus just the America First type policy should have benefited industrials. And again, that hasn't borne out to be the case. The policy didn't come to bear as many anticipated, but also the market reaction certainly hasn't been there either. So more than anything, we could certainly go through this similar exercise with other presidencies. I think all of us would be very well served to have a healthy dose of skepticism when we do read in the press or see on TV and hear confident, well-articulate pundits out there predicting or telling us what was going to happen in markets pending XYZ election outcome. Just looking at the experience over now the last 12 years, I'd say predicting the markets has been anything but an easy task or a foregone conclusion based on politics. State Street Global Advisor, one of the rates, the potential for volatility in the months ahead, or in the near term ahead now, given the election just around the corner. Oftentimes, there's a lot of uncertainty. There's going to be volatility. There's the potential for a contested election, which is being cited as a major source of risk to the market. One of the things I just want to stress here is that, as with all things market related, it's surprises that matter, right? If everybody knows something, theoretically, that ought to be already included in the prices of securities and marketable securities. us, what we see here. This plots what's called implied volatility. It's derived from the options markets. Many of you have probably heard of the VIX, or the quote unquote fear gauge. That's simply a measure of volatility implied in options markets. And what we show here is that options markets, and we can show it in a whole host of other markets, but just looking at S&P 500, there's already a lot of volatility implied in markets. So we show what's called the VIX curve. So it's just showing where the VIX is anticipated to be 1 month, 2 months, 3 months, et cetera, out. As of September 20th, there you can, or securities prices is what I would contend in this. Something that we should be mindful of and aware of, that, hey, yeah, it very likely may be choppy and volatile over the coming months, but also in many respects it's already embedded in the market prices, and that's not a unique source of insight or something that we could look to necessarily profit from. I threw this slide in here. This is about contested election, right? A lot of talk about, given the expansion of voting by mail during this election season, really a rampant expansion, mostly through the Midwest and the East Coast. For many of us are likely aware that, the West Coast, a number of states have had pretty significant amounts of mail-in vote for years. There's a lot of uncertainty going on with some changing rules related to the pandemic on the East Coast, but nevertheless, we're likely to see a pretty significant expansion in mail-in voting. This is resulted in a lot of concerns about the potential for a contested election, and that we may not know the outcome of the election on November 3rd on election day. Fortunately, we can look back to 2000 election for the last time we had a contested election, so Bush v. Gore. We can at least look at it as to see what happened in there. I would contend there's a lot of unique differences from that election season from what we're seeing today. But nevertheless, thought it would be instructive just to see what happened to markets during that period. And so election day was November 7th, 2000. It wasn't until December 12th that the Supreme Court ruled in Bush's favor, and Gore ultimately conceded on December 13th. And what we do is just plot on the left-hand side the performance of various asset classes during that period. And you can see kind of the time series of it there, and then the overall result on the right-hand side. And what we see is that during that period, stocks, as measured by the S&P 500, declined by about 5% during that period, emerging markets by a little more, international developed by a little bit less. You did see some segments of the stock market hold up quite well, namely low volatility as well as high quality stocks. So many of you are likely aware that your portfolios currently hold a decent slug of stocks of both minimum volatility as well as high quality, kind of as a part of our current defensive posture within markets, within the equity markets. Asset classes like the AG, as it's put there, which is broad investment grade bonds, delivered positive returns, as did U.S. Treasuries. What I'd say before we draw too many conclusions that a contested election would be unanimously a bad thing for markets and that we're likely to see another sell-off. A few points I'd add. The sell-off there, 5%, is, in the grand scheme of things, pretty much noise. We've already seen just during the early weeks of September, we saw the S&P 500 drop by nearly 10% over a span of a handful of days. 5% in the grand scheme of things of markets is very much noise. The other side, there's a lot of idiosyncrasies to that event that certainly aren't relevant today. For one, the idea of a contested election came as a surprise to folks. In this instant, as we just talked about on the previous slide, markets are already anticipating a lot of volatility. The fact that we're already having this discussion about potential for a contested election shows that were one to occur, it very well may be taken in stride, as many are already anticipating that to be the outcome. The other side I would add, where there may be some differences from the 2000 period versus today, is that the market already had been in a bit of a general decline. So the dot-com bubble officially peaked in March of 2000. Markets have kind of bounced around from March 2000 through late August into early September. They came very close to actually topping a new all-time high in late August, early September. But by the time we had reached election day there in November, the S&P was down about 7% from where it stood in late August. So we had seen a general decline. The economy had already been slowing as we saw that decade-long expansion nearing its end. The economy did enter a recession a couple months later. So there was a number of factors, namely slowing economy, already declining markets that were present then that aren't today, plus the stated factor already too that the contested election did come as a surprise. So how much we can necessarily learn or take from this as a playbook, I'm not so confident of. But just for those of you that were curious, you did see a modest decline in there, but something that I would contend is certainly manageable to all of us as long-term investors. For those of you still, perhaps unconvinced that elections are something that can be profitably traded, I would just, again, where we approach this is and why we tend not to look at elections, whether it's the presidential election, midterms, whatever you want to have it. From a policy perspective, we don't have it drive too much of our investment process, just because we think there's a lot of variables that one needs to account for, and the ability to accurately predict all of them is quite limited or remote in our estimation. So just thinking about the upcoming presidential election, if we were looking to build an investment strategy that sought to profit off of what happens in the election and ultimately the policy, we'd have to think, probably predict quite a few things accurately. Right, we need to know who's going to win the presidency. We'd have to think about, by extension, then given the presidency as the executive branch versus the legislative branch, we'd have to think about the composition of Congress. So who's going to win the Senate, who's going to win the House. Maybe then we could even get all three of those things right, but we need to then know, based on kind of the above three, what are going to be the key policy priorities of both Congress and the president. What are the likelihood of all of those key policy priorities ultimately becoming law? And then beyond all of that, we need to consider the fact that, as we saw with both the Obama as well as Trump examples, that to what extent are all of these already incorporated, these assumptions or conventional wisdoms already incorporated into market prices, and thus not something that would be easy to profitably trade on. And so we look at it and say there's just a lot of moving parts that we would need to get right to really make a significant move in portfolios where we try to profitably exploit an election outcome. And so it's something that we view with a healthy dose of skepticism in our perspective, and it's just not something that we typically look to enact in portfolios. Nevertheless, as I look to the long term, there are a handful of sources for optimism in my perspective as a long-term investor. I think that regardless of the outcome of the election, there's a handful of factors or longer-term support mechanism that stand to benefit the equity markets globally. I think first and foremost, just less policy uncertainty. So lifting that cloud of uncertainty of not having the election forthcoming, but then having it in the rearview mirror, I think will help. I think just as businesses around the world, as investors around the world try to look forward, having an election looming and potential changes to policy is just a source of uncertainty that probably holds back or weighs on confidence, holds back decision making, that I think once that's in the rearview mirror, that will help. Points 2 and 3, just from I think we stand to benefit from massive amounts of ongoing stimulus, both on the monetary policy side as well as the fiscal policy side. So from monetary policy, Fed Chairman Powell has, the Fed has recently revised how it thinks about inflation. The end game of all of that is that basically the Fed moving to an average inflation targeting regime really sets the stage for them to remain uber accommodative from a monetary policy standpoint for really multiple years ahead. And so it's unlikely we're going to see the Fed raising rates anytime in the near-term future, and that the Fed will continue to stand ready to provide monetary policy support on an as-needed basis. On the fiscal policy side, right, a lot of debate ongoing right now about will there be yet another wave of stimulus policy. It doesn't seem likely that that's going to occur by election. It's possible it does, as these things seem to change from day to day, tweet to tweet. We shall see where that goes. I think, regardless of the outcome of the election, you are likely to see another round of policy, of fiscal policy stimulus. Either could be um, right after election or maybe after the inauguration. But nevertheless, we stand to see probably another wave. Both of those sides, again, it's important not to impose our will on markets. I think we need to recognize that policy stimulus from both monetary and fiscal policy both tends to be quite well received by markets. It does, from a transaction mechanism, seem to increase people's confidence in the market and drives market prices up. So sentiment tends to be positively boosted by those, and so those tend to support the market. Uh, I'd say on a COVID-19 perspective, we're likely to continue to see improvement on that front, whether it's development of vaccines, whether it's increased therapeutics, whether it's simply the virus continuing to spread around the globe and potentially achieving some sort of herd immunity. Regardless, the passage of time should benefit us from a virus perspective. And then the last part there, probably a combination of all of those, is just a continually improving economy as we dig ourselves out of the deep hole caused by COVID during the second quarter. You'll see a continually improving economy with likely declining unemployment rate, increased growth. Third quarter GDP growth estimated right now to be somewhere to the tune of 25 to 35% on an annualized basis. Just a number unheard of before. Obviously that's coming on the backs of an unheard of poor number during the second quarter. But nevertheless, the economy is on the mend. We are improving. And as a result of that, you're likely to see continually improving corporate earnings. So saw a big decline there in the second quarter on a year-over-year basis, a smaller now decline in the third quarter on a year-over-year basis. But as we turn the corner into 2021, first quarter is likely to set the stage for once again growing year-over-year quarterly earnings. So a lot of good factors in my perspective as we look out on the horizon as an equity investor, regardless of what happens in the election. So with that, I will take a pause. That kind of concludes my prepared remarks. I will see if any questions came in during kind of my talk. So Nick, anything on the question side?
Perfect. No, thank you, Nick, for that. No, we didn't have any questions, and pardon me, I forgot to mention that at the beginning of the webinar. So if you do have questions, please do use the Q&A. We're going to answer those. We'll be on for the next, call it 5 minutes. If you want to stay on, answer any questions or chat through that, let us know. We'll address those. Otherwise, we really appreciate your time. We know how valuable it is, so we appreciate you guys joining us. Hopefully this helped to bring some clarity to kind of the way we view it and why you should kind of keep your politics out of your portfolio. A little hard to do, but that's kind of what all this entailed. So thanks again, Nick, for that. We'll stay on again for another 5 minutes or so and answer any questions that come in through the Q&A. All right. Looks like we don't have any. So thank you guys very much for tuning in again. Have a great rest of your day. Take care.
Ron?